Welcome to the Dep Dive. Today, we're looking at something pretty puzzling in the market, something you flagged for us. You've got gold, silver, both surging. The U.S. stock market, it's right up there, near record highs. But then there's Bitcoin. It's been, well, pretty much trading sideways since, what, early spring? Maybe. It's just not doing that big melt-up thing you might expect near the end of a, typical bull run.
Exactly. That sideways action, it really stands out. It kind of defies the usual script for this point in a market cycle. So our mission today is to really dig into this. We want to unpack the big question. Has the Bitcoin bear market maybe already started, but it's just hidden? We'll look at it from two angles. First, those big external economic things that might be masking weakness. And second, the internal stuff, things specific to Bitcoin itself that might actually be causing the weakness, holding it back.
Right, and the kind of central idea weaving through this, the one that seems to tie it together, comes from Nick Szabo. He basically argues Bitcoin is, and I'm quoting here, in a bear cycle masked by the debasement trade.
Okay, so let's start with that mask. What is monetary debasement? It's actually a really old idea. Way back, it literally meant a government, mixing cheaper metals into gold or silver coins. Less gold, less silver.
Yeah, the classic move when empires start to crumble.
Precisely. Fast forward to today, in our fiat money world, it's basically the same effect, just different mechanics. It's the loss of purchasing power, your dollar, your euro, whatever. It just buys less stuff.
Yeah.
Fewer goods, fewer services. And the main driver now, it's usually central banks like the Fed expanding the money supply, printing money, basically, which dilutes the value for everyone holding it.
Okay, and we should probably be clear how that relates to inflation because people often use those terms interchangeably.
Good point. They're really two sides of the same coin, aren't they? Inflation is when the price of goods goes up. Debasement is when the value of your money goes down. Same phenomenon, different perspective. And, the sources we looked at really hammered at this point. Official measures, like the US CPI number for inflation, they often argue it deliberately understates the real hit to purchasing power, the true level of debasement.
So if the official numbers aren't maybe telling the whole story, we need another way to see it, right? Something more real world. Which brings us to this interesting measure you found, Parker Lewis's ribeye index. Tell us about that.
Yeah, it's a pretty stark example. It basically tracks the price of the same cut of steak from the same place over time. And the idea is to show the dollar, quote, failing against Texas ribeye. And Parker Lewis posted the data. This was October 9th. The price for that same ribeye was up 6.2% just since June.
Okay, but hang on. A ribeye steak, that's a pretty specific, maybe even luxury item. Is that really a fair way to measure general purchasing power loss? Or is it just showing where, excess money is flowing for people who can afford expensive steak?
That's a totally fair question. It's definitely not tracking, say, the price of bread or electricity for the average person. But it works as a really potent indicator, I think, a sort of canary in the coal mine for where liquidity is pushing prices and how fast the dollar's losing ground against certain things people actually want. And the longer-term numbers are, frankly, kind of staggering. Since 2020, it shows a compound annual inflation rate of 12.6%. That adds up to a cumulative price hike of 72.5% for that steak. So yeah, it's niche, but it definitely points to serious debasement, at least at that end of the market.
Okay, so we've established the backdrop. The dollar, the ice cube, as Szabo puts it, is melting pretty fast. Now, normally, that kind of environment should be rocket fuel for Bitcoin, right? Which really supports Szabo's idea. Bitcoin would probably be falling harder if the dollar wasn't weakening so much underneath it. So to really isolate Bitcoin's own issues, we need to compare it to something else, like gold. See how things look relative to gold.
Exactly. Gold is sort of the traditional benchmark here. If the dollar is weak, gold should be doing well. And it is. When you actually measure asset performance in gold terms, not dollar terms, you really see that fundamental dollar weakness shine through.
Okay, so how does gold stack up against Bitcoin itself when measured that way?
Well, interestingly, gold has actually been getting stronger relative to Bitcoin for pretty much all of 2025. The price ratio between them has kind of bounced around in a range for the last couple of years. Yeah, but the trend this year, it's definitely favored gold over Bitcoin.
And what about against traditional stocks, say the S&P or NASDAQ?
Oh, there's even clearer. Gold has been massively outperforming both the S&P 500 and the NASDAQ 100, the QQQ, for the whole of 2025. So the big takeaway for you, the listener, is this. The dollar is fundamentally weak against hard assets right now, no question. And that underlying weakness is acting like a safety net, holding up Bitcoin's dollar price. Even while Bitcoin itself might be showing relative weakness compared to gold, It's masking what's really going on with BTC.
Okay, so if the dollar's melting and should be lifting Bitcoin, but Bitcoin is lagging, that points strongly towards internal problems, right?
Yeah.
Something specific to Bitcoin must be disappointing the market or causing drag, powerful enough to counteract that huge debasement tailwind. What are those issues?
Right. This is where we get into the, let's call them structural risks or headwinds specific to Bitcoin right now. The sources point to about three main factors that seem to be creating uncertainty and maybe suppressing demand.
All right, let's take them one by one. Factor number one, this tension around governance, specifically the main software, the reference implementation.
Yeah, that's a big one right now. The reference client, Bitcoin Core, made some changes this year, particularly in version 30, that have caused, well, let's say controversy. Specifically, they removed certain filters that used to block some types of non-standard transactions. And this has created fear, at least among some parts of the market, that someone could now potentially flood the network with junk data, or maybe even mine a problematic large transaction block, what some call a nasty large OPR.
Mm.
The worry is about network stability, spam, maybe higher fees, things that long-term holders really don't like to see uncertainty about. The market seems to want these governance issues sorted before the next big move up.
Okay, so fear about network stability, potential spam, that naturally leads into the second point, doesn't it? The idea that maybe a software update, a soft fork, might be needed to fix whatever problems Core 30 might have introduced.
Absolutely. Uncertainty around potential changes to the core protocol, even beneficial ones like a soft fork, tends to make markets cautious. People wait and see. And then there's the third factor, which has really put a dent in one of the big narratives, the collapse or at least major struggles of these Bitcoin treasury companies.
Ah, yes. The idea that lots of corporations would start holding Bitcoin on their balance sheets, like MicroStrategy pioneered. That was meant to be a huge new source of demand.
Exactly. That was the narrative. And, well, it's hit some serious bumps in the road. The market seems to be pricing in much less future demand from that sector now. We've seen quite a few of the companies trying to copy the model run into trouble. Metaplanet and Nakamoto, total disasters, really. Kinley stock did a complete round trip back to square one. Strive is crashing. There might be, 10 or 12 similar companies facing issues. It just looks like that wave of corporate adoption isn't materializing as smoothly or quickly as maybe some hoped.
What about MicroStrategy itself? I mean, they're the original, the biggest player. Are people worried about them too, or just the copycats?
Well, the sources suggest MicroStrategy is seen as more robust, maybe having a moat. But even its performance signals some caution. If you measure MSTR against the dollar, its stock price actually peaked back in November 2024, shortly after the election. And since then, it's basically been trading sideways to maybe slightly down. It suggests that maybe investors are rethinking if holding Bitcoin through a leveraged company stock is the best low-risk way long-term, especially thinking about debt or potential share dilution down the line.
Okay, let's shift gears a bit. Forget the current news for a second. Is there anything in Bitcoin's past, like a historical pattern, that might suggest a cool down or bear market could be due around now, regardless of these internal issues?
There is one pattern people point to, though it's definitely speculative.
Oh.
It's based on the annual price charts, specifically the color of the yearly candles. It's called the 3 green, 1 red pattern. A green candle just means the price finished the year higher than it started. Red means it finished lower.
Okay, 3 green, 1 red. And what does that pattern supposedly tell us?
The idea is that historically, after 3 consecutive years where Bitcoin closed higher, 3 green candles, it tends to be followed by a year where it closes lower, a significant red candle year, a bear market year. This seemed to work in the cycle leading up to the 21-2016 bottom, and it worked again in the 2019-2021 period, which was followed by the big drop in 2022. 2022 was the red year after 3 green.
Wait, hold on. Are we really saying a major asset's future might follow a pattern that's only clearly happened twice in the last decade or so? That sounds less like financial analysis and more like, I don't know, reading tea leaves. Isn't that incredibly risky to rely on?
Oh, absolutely. It is highly speculative. And the sources are very careful to point out that the data before, say, 2015 is much less clear. It really only fits neatly for the last 2 big cycles. But it's out there. People talk about it. And if you follow that pattern logic, well, we just finished 3 more green years, 2023, 2024, and presumably 2025 if it holds. So according to that pattern, a down year, a red year, would be expected either starting about now or certainly looking likely for 2026. It's just a historical flag, definitely not a prediction set in stone.
Okay, so pulling this all together, what's the takeaway for you, the listener, who might be holding Bitcoin through all this? You've got this massive force of monetary debasement potentially pushing the price up, but you've also got these serious internal worries, governance, corporate demand maybe faltering, pushing it down. Plus, this speculative historical pattern suggesting caution. The sources seem pretty clear. Nobody has a crystal ball here, and trying to perfectly time market swings is probably a fool's errand and maybe an expensive one.
Yeah, the caution against trying to jump in and out is pretty strong. A big reason is just taxes, the capital beans tax problem. If you sell Bitcoin now at a profit, you're likely looking at paying, what, 20%, maybe 25% of that profit in taxes, depending on where you are in your situation. That means Bitcoin would have to fall by that same percentage, 20, 25%, just for you to break even if you buy back in later, after accounting for the tax hit.
Wow, yeah. That really raises the bar for being right. You have to be right about getting out and right about getting back in, just to not lose money compared to holding.
Exactly. It makes timing incredibly difficult. And since nobody knows for sure if past cycles have to repeat or what the future holds with these internal issues, the strategy that comes up again and again in the source material is basically just hodl. Hold on for dear life. It's seen as the simpler way to stay exposed to the potential long-term upside without taking on the huge risk of mistiming the market.
So let's just summarize the tight spot Bitcoin seems to be in right now, based on everything we've discussed.
Yeah, it really feels like it's caught between two powerful forces, a vice, maybe. On one side, you have this relentless monetary debasement, the dollar losing value. That's providing a strong tailwind or maybe a price floor, keeping the dollar price relatively high. But on the other side, you have these significant internal weights, the governance uncertainties, the worries about corporate treasury adoption slowing down. Those are clearly holding it back.
But despite all that current turbulence, the core long-term argument, the reason for that hodl strategy, it still holds, right? The idea that Bitcoin is ultimately heading much higher, maybe $1 million or more eventually. Why? Because, as the saying goes, fiat money has no bottom. That debasement is the long-term driver.
That's the fundamental thesis, yes. And it leads to maybe a final thought for you to chew on. These internal Bitcoin issues, the governance stuff, the corporate treasury narrative, they're messy. And the road ahead will probably be, rough and rocky sorting them out. But the expectation is they will eventually get sorted out by the community. The monetary debasement, though, that's likely structural and ongoing. It probably won't get sorted out. So that patience, that fortitude to hold through this current period of uncertainty and likely volatility, that's probably what's needed to capture the potential gains driven by that unstoppable debasement trend over the long run.
A really interesting and complex picture. Thank you for sharing these sources with us and letting us take this deep dive into where things stand. We'll catch you next time.